Have you ever felt overwhelmed by the jargon and complexities of the financial markets? Are you looking for a comprehensive lesson to make sense of CFD trading terminologies? Hi friends, welcome to today's lesson where we are going to understand trading terminologies in a very simplified manner. It may sound a bit jargony, but don't worry, we're here to break it down for you. Understanding these terms is very important if you want to succeed in Forex trading. So let's dive in. CFDs. First on our list is CFDs, or Contract for Difference, CFD. It is a derivative contract in which the difference in prices of underlying assets is exchanged between the participating parties without actually owning them. It's basically speculating on the price movement of an instrument without owning the instrument. Think of it like this. Imagine you want to trade shares of a tech giant like Apple, but you don't want to buy the physical stock as it is costly. With CFDs, you can speculate on the price movements of Apple's shares by opening either a buy or sell trade on your broker's platform at a fractional amount. And the best part? CFDs aren't limited to just stocks. You can apply this method to various instruments, including currency pairs, commodities like gold or oil, cryptocurrencies. Let's take a classic example, the Euro-USD currency pair. In this pairing, EUR stands for the euro and USD is the US dollar. The price of Euro-USD indicates the exchange rate, showing you the value of 1 euro in terms of US dollars. So if the current price is 1.2000 for Euro-USD, it means 1 euro is equivalent to 1.20 US dollars. Here, the euro is the base currency and the US dollar is the quote currency. The base currency is your starting point. It's the currency you're using to make your comparison. In our example, the euro is the base currency and you're comparing it to the US dollar. The quote currency is the one you're measuring the base currency against. It tells you how much of the quote currency you need to exchange for 1 unit of the base currency. Bid and ask. You would have often heard these terms, the bid and the ask. The bid is the highest price that the market is willing to pay for a currency pair at a specific moment, while the ask is the lowest price a market is willing to accept. Let's illustrate this with an example using the popular Euro-USD currency pair. If you see Euro-USD with a bid price of 1.08480 and an ask price of 1.08482, it means that at that moment, you can sell Euro-USD for $1.08480, the bid price, or buy Euro-USD for $1.08482, the ask price. Spread. Now, here's where the spread comes into play. The spread is the difference between the ask and the bid prices. It represents the transactional cost you'll incur when you open a trade. Continuing with our Euro-USD example, if the bid price is 1.08480 and the ask price is 1.0851, the spread would be 3 pips. This is the cost you pay to enter a trade. Here's a quick question for you. Why don't Forex traders ever get invited to picnics? Because they're always too focused on their spreads and they're afraid they might miss a picnic. Now let's unravel the concepts of going long and going short in Forex trading. To go long in the Forex market means that you expect the value of a currency pair to rise. It's like making a bet that the pair's base currency will strengthen compared to the quote currency. Imagine you're looking at the Euro-USD currency pair and you decide to go long. Let's say the current price is 1.08500. You believe that the euro will strengthen against the US dollar, so you buy the pair at 1.08500. If your prediction is correct and the price climbs to 1.08600, you can sell the pair at this new rate, making a profit. Going long is essentially buying low and selling high. On the flip side, going short means you anticipate a currency pair's value will decrease. In this case, you're betting that the base currency will weaken compared to the quote currency. Continuing with the Euro USD example, if you go short, it means you're selling the pair at the current rate of 1.08500. If your prediction holds and the price drops to 1.08400, you can buy the pair back at this lower rate, profiting from the decrease. Contract and lot sizes. Eyes wide open? Fantastic, because understanding this is going to be a real game changer. A contract refers to the standard unit size for a particular instrument, while lot size indicates the quantity of contracts you buy or sell in a single trade. To illustrate this, let's consider a common lot size in Forex, which is the standard lot. A standard lot equates to 100,000 units of the base currency. So for the Euro USD currency pair, a standard lot would be 100,000 euros. Suppose you decide to trade one standard lot of Euro USD at a price of 1.08500. This means you're trading 100,000 euros. If the price moves in your favor, say to 1.08600, you'd make a profit of $100 because your position has gained in value. However, if you were trading one mini lot, which is 10,000 units of the base currency, your trade would involve 10,000 euros. And for a micro lot, it's just 1,000 units of the base currency, or 1,000 euros in the case of Euro USD. Think of it like ordering at a restaurant. The contract is like a standard menu item, say a pizza, which comes in a fixed size. The lot size is how many pizzas you order. You can order a single pizza, micro lot, a few pizzas, mini lot, or a large group of pizzas, standard lot. Lot sizes and relationships have a lot in common. You can't just pick a random number. It's about finding the right fit, adjusting when necessary, and knowing when it's time to cut your losses. Volume and margin. Now let's shift our focus to volume and margin. Volume refers to the number of lots or contracts traded for a particular currency pair within a specified time frame. It's an indicator of how active and liquid that currency pair is in the market. When you see higher trading volume for a specific currency pair, it often indicates increased interest and participation. Think of it as a crowded Forex market with more traders involved, leading to more opportunities. For example, if you are monitoring the Euro USD currency pair and you observe a sudden surge in trading volume, it might suggest a significant market event like an economic announcement or geopolitical news is influencing trading activity. In Forex trading, they say volume speaks. Well, my volume speaks so loudly that even my neighbors know when I'm losing money. Let's discuss margin now. Margin is the minimum amount you need to keep in your trading account to open and maintain a position. It's usually expressed as a percentage, and it ensures that you have sufficient funds to cover potential losses. Margin requirements can vary between brokers and even between different currency pairs. For instance, suppose you intend to trade a CFD with a total value of $10,000 with a leverage of 50-1. In this scenario, you need to have at least $200 in your trading account to enter the trade. Leverage. Enjoying the ride so far? Hold on tight because we are moving on to leverage. Leverage can significantly amplify your trading potential, but it comes with its own set of considerations and risks. It's a tool provided by brokers that allows you to control a more substantial position with a relatively smaller amount of capital. It's like borrowing funds from your broker to increase the size of your trade. Let's say you have $1,000 in your trading account. If you're not using leverage, you can only trade trading instruments worth $1,000. However, with leverage, your broker might offer a leverage of 50-1. This means for every $1 you have in your account, you can control a trade worth $50. So with your $1,000 and a 50-1 leverage, you can now trade position size of $50,000, 50 times your capital. Think you've got it all? Well, hold on, we've got more in store. Moving on to market order and pending order. A market order is one of the simplest and most commonly used order types. It's an order to buy or sell a currency pair at the current market price. This means your trade will be executed immediately at the prevailing market rate. Market orders are like speed dating for Forex traders. Quick decisions, no time for second guessing, and sometimes you end up with a surprise. Let's say you're closely watching the Euro-USD currency pair, and the current price is 1.08500. If you decide to enter the market with a market order to buy, your trade will be executed at 1.08600, the best available price at that moment. On the other hand, a pending order allows you to specify the price at which you want to enter the market. Your trade will only be executed if the market reaches that specific price point. Imagine Euro-USD is currently trading at 1.08500 and you believe that its price will fall to 1.08400. So you can place a pending order at 1.08400 to be executed in the future only if the market price reaches this price level. Think of it like ordering a product online. With a market order, you purchase the item at the current listed price, just like buying something in a store. With a pending order, it's like placing an order for a product, but specifying the price at which you want it to be shipped to you. Once the product's price matches your specified price, the order is executed. Pending orders are like your long-lost relatives. They're hanging around, waiting for the right moment to just show up and surprise you. Now, here's a question for you. Have you heard about the pending order's favorite hobby? It's waiting. It's got infinite patience, just like your grandma. Let's discuss gap up and gap down. A gap up occurs when the opening price of a trading period is significantly higher than the closing price of the previous period, leaving a visible gap on the chart. Conversely, a gap down happens when the opening price is significantly lower than the previous period's closing price. Let's say you're monitoring the Euro-USD currency pair, and on Friday evening it closes at 1.08500. When the market opens on Monday morning at 1.08600, there's a gap between the two prices, with the market opening higher than the previous close. This is a gap up. In contrast, if the Euro-USD closed at 1.08500 on Friday and opened at 1.08400 on Monday, there would be a gap, but this time the market opened lower than the previous close. This is a gap down. Oh, you look a bit exhausted. Well, relax. This is the last one. Swaps. Swaps, also known as rollover or overnight financing, are the interest rate differentials between the two currencies in a currency pair. When you hold a position overnight, you may either receive or pay a swap, depending on the interest rate differential between the two currencies. Let's consider the Euro-USD currency pair. The euro and the US dollar have different interest rates set by their respective central banks. If the euro has a higher interest rate compared to the US dollar and you go long on the Euro-USD, you receive a payment swap. Conversely, if the US dollar has a higher interest rate and you're long on the Euro-USD, you pay a swap. The swap payment is usually calculated on the value of your position and can either be credited to your trading account or debited from it. Think of swaps like the interest on a loan. If you borrow money, you pay interest. If you lend money, you receive interest. It's essentially the cost or benefit associated with keeping a position open overnight. Forex swaps are like playing a game of musical chairs, except instead of a chair, you're trying to find a currency pair that didn't depreciate overnight. And that's all for today. If you like this video, don't forget to hit the like button and subscribe to our channel.